Well, 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 I hate to say I told you so, and frankly, I don't make swing calls, I don't trade, I don't do any of that crap, because I know I would lose my shirt. But I made a good call yesterday. I don't have a problem patting myself on the back a little bit. Um, those who were fooled by yesterday's short covering rally, who seriously thought that the Fed coming out and saying, no, we're not going to hike 75 basis points, we're only going to hike 50 basis points, was so bullish that, okay, the bear market's over. We need to go back to risk on. That changes everything. Those of you who are fooled by that, you lost your shirt today. And I still am not going to give investment advice. I'm not going to say, see, I'm so smart, you should listen to what I say in the future. All I'm saying is that, hey, when I'm right, I'm right. And I'm only going to talk about the past. I was right about the past. Past performance is not indicative of future results. And maybe you should look at this as, hey, even a bum like me, who would lose all my money if I tried to trade, could see this coming a mile away. It was that obvious. Okay? I'm not a genius. Anyone could have seen this. The people who fell for yesterday's fake out rally should just feel silly. Everyone knew that the 75 basis point, hoax was just that. Nobody seriously thought the Fed was going to do that. There was only the only whispers that we got about 75 basis points. It came from nobody at the Fed. It came in the form of just that whispers, rumors, on FinTwit. Less than 12 hours. Well, maybe not less than 12 hours, but less than 24 hours before Powell's press conference. And so it's not like all of this selling that's gone on for the past few weeks has been pricing in a 75 basis point rate hike. Far from it. They were pricing in a 50 basis point rate hike. And so when that 50 basis point rate hike came, they covered their short positions because that was the trade. The trade that a lot of the shorts, not everybody, some people were just selling to get out of the market. That's true. But the short sellers, there was a clear trade. Hey, Powell's going to hike 50 basis points. That's not good for the stock market. Let's short stocks. And so when that 50 basis point rate hike came to pass, they covered. In fact, I think the covering began a couple days before. Because it's kind of like the betting markets. You don't necessarily want to wait until the election results are finalized if you're betting on an election or a sports game, and wait for the payout from the betting site. Whether you're using Predict It, I guess, is the big one, or Betfair. A lot of people will cash out ahead of time, just like if you're trading options. So the rally that we saw this week was just that. People were cashing out, and now they're loading up on short positions again, because now we're being told that the Fed is going to hike by another 50 basis points in June, and the Fed has shown no sign that they're going to let up. Now that might change, and if that does change, there might be a rally, and the shorts might take some losses there, or maybe they'll get out in time. Who knows? Those are the risks you take when you decide to make these kinds of trades. But for now, the sell-off continues. The crash has resumed, and risk parity, as Zero Hedge has been pointing out, is most affected by this crash because we're seeing yields spike and stocks crater. And, I think there is a bit of schadenfreude because risk parity only works to smooth out normal market volatility. It in no way will protect you or give you any sort of security when it comes to, a major market crash. Because in this kind of a crash, in a financial crisis, which is what we're progressing towards. I'm not saying that we're going to get to that stage, but that's the direction we're going. In a financial crisis, You don't want to own any of these risk assets, whether they be bonds or stocks. And so risk parity overall is going to be a much worse strategy than just buying all stocks, frankly, or just buying all bonds, because you've got a lot less upside because you've got that heavy bond allocation. But then when both of those assets, stocks and bonds, fall off a cliff, you may not fall as far as a 100% stock allocated portfolio, but you're going to fall pretty damn far. Which, in my opinion, is why something, like gold is a lot better if you're trying to smooth out volatility. I think that gold does a much better job of that than something like bonds. But don't get me wrong, I'm not one of these buy gold guys. I'm not that kind of a gold bug. I am a gold bug in the traditional sense, in that, I think the gold standard is a much better monetary system than whatever garbage we've got these days. But I'm not one of these, here, buy your gold from my sponsor using my link. All I'm pointing out is that in this kind of a situation, if you took, any random risk parity fund, and you replace the bond allocation with a gold allocation, you'd be doing much better right now. Because yes, your stocks would be cratering, but you've been able to take advantage of all the growth in stocks over the past few years, but you've still got a lot of value that will be retained in the form of that gold allocation. Because what you're doing, if you're maintaining in percentage terms the same allocation, you've been progressively, as your stocks have been rising in value relative to your gold, you've been selling off little bits of your stock, putting it into gold, moving it into gold, so that you have 40% or something, even though I don't think 60-40 is risk parity. I forget what risk parity is exactly. But a 60-40 portfolio, everything I'm saying, all this also applies to that. I mean, if you've got a 60-40 portfolio in 2022, I'm sorry, you're too boomer to deserve your wealth. But boy, I'm getting pretty off topic. The topic for today is the resumption of the crash. Which, by the way, that 50 basis point rate hike yesterday is even more significant than I realized at the time, because I said, I thought that they did 50 basis point hikes back in the 05 to 08 tightening cycle. That was wrong. Apparently, they haven't done a 50 basis point rate hike since 2000, which I guess would be the dot-com bust. So I've forgotten that it. I mean, that makes sense. I didn't remember exactly what the rate hike schedule was back, in the mid-2000s. But this 50 basis point hike is even more significant because of that. And here's the thing. Powell's going to have to keep hiking if he wants to beat inflation, because when you look at where gold's at, when you look at where food's going to be because of the fertilizer crisis, I don't see how commodities, essential commodities, basic commodities, are going to come down unless you really, really do destroy, a huge fraction of the demand in the U.S. economy. It's not just that people are spending too much, which is an issue, including the federal government, obviously. It's not just that, though. Prices are going up because of the supply side shock as well. And rate hikes aren't a direct cure for a supply side shock. Rate hikes are not going to create more oil. Rate hikes are not going to create more fertilizer. Rate hikes are not going to grow more wheat, more corn, more soybeans. Rate hikes are not going to feed our cattle. Rate hikes are not going to move all those ships smoothly through the Chinese ports and get them on their way back to Europe and North America. Rate hikes are not going to unload those ships. So there's a lot driving the price increases in the U.S. economy, other than monetary inflation, that these rate hikes are not going to be able to address. And so we might, even if the Fed, which the Fed is not going to do this, they're not going to hike this much, even if the Fed hiked enough to deal with the monetary cause of inflation, we would still have rising prices in this country. Hell, look at the 10-year. We got up to 3.10% today. That That's pretty damn high. We're approaching 3.15, which Peter Schiff pointed out. I didn't have time to double check this. Peter Schiff said that was the peak back in December of 2018. Wouldn't surprise me. Lo and behold, it all comes back to 2018. That's when this should have happened the first time. We're way overdue. We were overdue for the crash back then because it should have happened in 2008. The Fed pressed the pause button. They said, okay, we're not going to have this. We're not going to have a total collapse of the system now. But they didn't fix any of the underlying problems. All they did was they hit pause. They said, you know what, let's kick the can down the road. And that's what they did for 10 years. And then 2018, when they were hiking rates, it looked like, okay, the Fed has unpaused the 2008 GFC. We're going to go into another crisis. It is going to resume, and everything's going to come apart. And then Powell flip-flopped, and he came down the road again. And now here we are 4 years later. Gosh, it's hard to believe. 4 years. And so, are things better now than they were in 2018? Are the fundamentals more stable or less stable? Is there more rot or less rot in our financial system? I think you know the answer to that. And so why would we expect a different result? The Fed is hiking. Just like they were, before 2008, just like they were in 2018. And so it's all coming apart before our very eyes. What will be the real nail in the coffin, though, is if the 10-year is able to continue to rise. If the 10-year breaks out higher than it peaked in 2018, if it hits 4%, if it hits 5%, then we're in game over territory. Because if we get that high, the federal government's not going to be able to service our debt, and it will be bankrupt. And beyond the federal government, there's going to be a lot of other people who go bust too, because our financial system is not predicated on rates that high. And, it feels like the inflation premium is dead, but maybe it has a little bit of life. Maybe the inflation premium's not dead. It's hard to say. There's always many factors that you can attribute to rising Treasury yields. And so I don't necessarily want to get into at this point trying to explain why that is. I'll put it this way, though. One thing I think we can rule out is that it is a direct, causally linked to the Fed raising rates. Honestly, it could be people front-running the next bull market in stocks. You never know. I mean, it could be something as silly as that. It could be, stocks are so bad right now, the Fed has to pivot at some point, and that'll be bullish for stocks, which means people will sell their bonds, and so people are front-running the sale of treasuries in that sense. I mean, that's what I mean. Is that I just made that up off the top of my head. You can come up with any number of explanations for why Treasury yields are doing what they're doing. But I don't try and do that, at least not too much, not recently. I just look at it and say, okay, what are the consequences of Treasury yields, at these different points? And we're starting to get into the realm where I say, gee, Treasury yields get this high, we're going to start to see some real problems, structural problems, not just stock market going down problems. So with that said, I will see you folks back here tomorrow.